All right, let's talk about something in trading that drives almost everyone crazy. It's a question that leads to so much confusion, so much second guessing, and honestly, a lot of losing trades. It trips up new traders and veteran traders alike.
Yep, that's the one. Is it the 1 minute, the 5 minute, the hourly, the daily? You've probably stared at your screen, flipping through charts 1,000 times, wondering if you're just missing something. Well, what if I told you the answer isn't a time frame at all? So, according to trader Carmine Rossato, who's the source for our deep dive today, making one single change completely transformed his results. We're talking better entries, better exits, and a way better risk to reward setup. And the secret, he says, was all about completely rethinking what a time frame even is. So let's break down what he figured out.
Okay, first things first, we have to understand the core problem. We get so obsessed with finding the right time frame, we kind of forget what its chart actually is. It's not some magic crystal ball. It's just a way of looking at data.
Take a look here. On the left, we've got a 5-minute chart. Looks like a pretty clear rejection up top before a big drop, right? Now on the right, that's the exact same market activity, but shown on a 30-minute chart. The candles tell a totally different visual story. But, and this is the absolute key here, the data underneath, the raw price and volume, it's 100% identical. And this brings us to a massive realization. A 5-minute candle doesn't cause a breakout any more than a 30-minute candle causes a rejection. The chart is just a container. Think of it like a filing cabinet for all the raw data. You're just choosing how to organize it. The chart itself doesn't drive a thing. So if the charts are just the display, what's the actual engine? What's really moving the market? To find that out, we have to look past the candles completely and focus on the real force at play. And you know what? It's as simple as Economics 101, supply and demand. That is it. That's the real reason prices move. If more people want to buy something than sell it, the price has to go up. If more people are trying to sell than buy, the price falls. And this happens completely on its own, no matter what chart you're looking at. This supply and demand pressure isn't some abstract concept. It's created by the real-time actions of traders hitting their buttons. It is a constant tug of war between aggressive buyers slacking the market order and passive sellers just waiting with their limit orders. The price moves based on who is being more aggressive and with how much volume, second by second. And this quote just nails the problem with only watching candles. A candlestick is the final result. It's the closed curtain after the show is over. A big green candle just tells you, hey, the price closed higher than it opened. It doesn't tell you why. It doesn't show you the actual battle of buyers and sellers that was raging behind the stage to make that candle. So, if the time frame is just an organizational tool, how on earth do you choose the right one? Well, the answer depends entirely on your goal. It depends on what kind of trader you are. I mean, think about it. Are you a long-term investor looking to hold a stock for 5 years? You couldn't care less about the 30-minute chart. You're focused on the daily or the weekly. Are you a swing trader trying to catch a move over a few days? Then yeah, higher timeframes are your bread and butter. But if you're a scalper or a day trader and your whole world is about what's happening in the next few minutes, your focus needs to be way, way tighter. And that brings us right back to the million-dollar question, especially for you day traders and scalpers who live and die by these quick moves. If the 1-minute, 2-minute, and 5-minute charts are all just lagging pictures of what's already happened, what's the secret? What's the solution here? The solution is to stop thinking in terms of time at all. It's about shifting your entire perspective from looking at the past to seeing the present. It's about trading in what Carmine Rossato calls the now. And that's it. The best time frame for a short-term trader is no time frame. It's the immediate present. It is the now. The now isn't some new chart setting you can click. It's a method. It's the actual practice of reading the tape, of analyzing the real-time transactions to see the battle between buyers and sellers as it unfolds. You're essentially looking behind that curtain to see who is winning the fight right now. Okay, I know this might sound a little abstract, but the practical benefits are just massive. So let's look at how trading in the now gives you a huge, huge edge over all the other traders who are just watching candles. Oh man, we have all been in this exact spot. You see a big, beautiful green candle just smash through a resistance level. You buy the breakout, you're excited, but if you were looking at the now, at the order flow, you might see a giant wave of selling volume hitting the market right at that level. The price looks strong, but the actual activity underneath is super weak.
The breakout fails, the price reverses, and everyone who chased that pretty green candle gets trapped. And think about it this way. If you wait for a 5-minute candle to close to confirm a move, you could be acting on information that is 4 minutes and 59 seconds old. The entire battle might have been won or lost in the final few seconds. By the time your confirmation shows up, the opportunity is gone, or even worse, it's already turned into a trap. Now, the second major benefit, this one hits your bottom line directly. Trading in the now can radically, and I mean radically, improve your risk-to-reward ratio on every single trade you take. Okay, let's say you see the market bounce off a support level. If you wait for a nice-looking candle to close higher to confirm that bounce, you might get in here at 50.25. Your stop loss has to go all the way below the low, which means you're risking 12 points. Just to get a decent 2-to-1 reward, the market needs to rally a full 24 points. That's a huge move to ask for.
But if you're watching the now, you can actually see the aggressive selling get soaked up by buyers in real time, right at the low. You can enter much earlier, say down at 50.17. Your stop loss is just below the low, which totally slashes your risk. Now that same 24-point target gives you an incredible risk-to-reward ratio. You're risking way less to make way more.
So let's bring it all home. Here are the key takeaways. First, and this is the big one, charts are just filing cabinets for data. Supply and demand is what actually moves prices. Second, the best focus is all about you. An investor's needs are totally different from a scalper's. Third, for short-term trading, your focus shouldn't be on time. It should be on real-time volume. And finally, trading in the now can help you dodge those nasty fakeouts and dramatically improve your risk management.
And that really brings us to our final thought. This whole idea forces you to ask a really simple but really powerful question about your own trading. When you click that button, are you reacting to a picture of what happened 5 minutes ago? Or are you acting on what's happening in the market at this very second? The answer to that question could change everything.